Now, here is Ticky Fullerton on Your Money.
Hello there, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. Coming up, the Swiss Stock Exchange is miles ahead on blockchain, talking innovation and economic headwinds with SIX Group CEO Jos Dijsselhof. Wheat exports to drop by 50% this year. That's the takeaway from a dire crop report out from Rabobank. We'll get the details from agriculture analyst Wes Lefroy a little bit later. And Parliament heating up in the UK with a potential Brexit extension on the table. We'll get the latest from Jasper Lawler from London Capital. OK, well, they're back. Ben Gray's private equity outfit, BGH Capital, and the industry super fund with the deepest pockets, Australian Super, have lobbed in another offer for Healthscope, and it's exactly the same price that they were offering shareholders back in April, $2.36. Shares in the hospital and property business lifted almost 20% today, having ticked down in the last month considerably. Perhaps they could argue, these aggressors, that they've given the shareholders the benefit of the dividend in the meantime, but it's pretty cute timing. The new bid comes just a week ahead of Healthscope's AGM and a trading update, and also the opening of the company's marquee Northern Beaches Hospital. What's more, Healthscope CEO Gordon Ballantyne has been working hard on the most attractive part of the business, for investors at least, its property portfolio, in a new deal to extract some value for shareholders. So one can imagine that the board and management right now would be super busy. Don't you just love the private equity MO? Interestingly, the new tilt also comes just as the current conditional arrangement that BGH Capital has with Aussie Super, you know, they were tied together, that was about to expire. That's now been extended to March. Another development since the last bid is that Elliston Capital, which owns 10% of Healthscope, but not a seat on the board, is pushing for the sale of the business to private equity and Oz Super, or at least pushing for Healthscope to open the kimono and allow some due diligence to take place. Now, what does that mean? We have three of the best investment pickers in the country, Ben Gray, Mark Delaney and Ashok Jacob, all seemingly enthused by this deal. You've got to think that there will be a little pressure on the board of Healthscope at the AGM. On the other hand, there are more conditions that you could poke a stick at this proposal, where were the board to agree to allow due diligence, they would also have to commit to cease Ballantyne's property transaction, and it was also have to guarantee the company's August guidance, and that is that cash flow, EBITDA, will grow no less than 10%. Well, it says something about the broader macroeconomic risks in the sector, including the Labour threat of capping private health insurance premiums, that Ben Gray is still at all interested. Well, that takes us back to the property assets. Gordon Ballantyne has been very vocal about his work in the past few months to de-risk the business for Healthscope shareholders. But the strategy is to sell only 49% in hospital assets. The 51% remaining ownership that he retains will give Healthscope important operational control of the hospitals, and presumably he'll keep rights over future property decisions. Now, that's not important for Healthscope shareholders who might want to sell out of the business altogether. Perhaps they're impatient about performance, but it will be very important to patients and other hospital customers. There's not such a commitment, certainly at the moment, from the private equity bid. Well, it will be interesting to see how next week's AGM plays out and the sort of questions the board gets from the floor. One of them might be, why is it OK for a major shareholder and board member, Aussie Super, to lock itself into a deal that would preclude it from supporting any superior offer that might be made for Healthscope, as happened back in Act 1 in April? Well, we'll come back to that subject a little later, but in other news today, shares in Coronado Coal were slumping after the float on the stock exchange today. Now, slumping badly. The IPO price was set at $4. The closing price, a little underwhelming, at $3.70. Well, for more details and for an insider's perspective on the refreshed Healthscope bid, I spoke with the Australian's Bridget Carter a little earlier. Bridget Carter, thank you for coming in. Now, a couple of deals, but they're back. Ben Gray and Aussie Super are back with Healthscope.
That's right. It was a bit of a surprise when this deal was announced on the ASX today. The thinking, I think, was that BGH Capital had its sights now on Navitas, the education company, and that their interest on Healthscope had gone cold, particularly because of the company's plans to sell the property portfolio.
Which was the great jewel.
That's right.
Yes, yes. So how has, the shares have obviously popped up, I think about 18% when I last looked. Now, what is the expectation there, do we think?
Well, it's interesting. The shares have rallied, but they're not close to the offer price. I think just talking to people around the market today, they say that they think it will be really hard for the company to suddenly accept an offer that's the same as the offer that they rejected a few months ago.
It hasn't gone up. It was a cash bid and it hasn't gone up at all, has it?
It's exactly the same price, and I think it's pretty unusual, this situation. I mean, I know myself, I can't remember seeing a deal where somebody's come back with the same price for a company. So it's pretty opportunistic, I think, what they're doing, and I think, you know, for the board to come back and say, we're going to accept it now, but we didn't think it was worth that a few months ago, is going to be hard for the board. But I do think there are shareholders who would like, to cash out of Healthscope. And I think they would like BGH to have the opportunity to do due diligence.
So do you think there's a chance that the board might say, well, OK, yes to due diligence, but we're not saying yes to an offer? That's
right. And then maybe they don't accept the offer, but some shareholders still choose to, because one of the things we know is Alliston Capital is in favour of the offer. They have about 10% of the stock. And of course, Australian Super, which is part of the offer, is a big shareholder. Don't forget, though, Northwest Properties, which wanted to bid for the properties themselves. They have about...
But I mean, Alliston Capital could just sell to Aussie Super, couldn't they?
They could. So that is a possibility as well. So anyway, we'll see if this private equity firm, this opportunistic approach they're taking pays off for them. But it's a very unusual situation.
It is. Well, it's very unusual to start off with, having, you know, Aussie Super sitting there on the register and sort of, joining forces with private equity in the first place to take over the company, and they've signed up to lock this position down all the way up to March now again with BGH.
That's right. So no one else can come forward and put forward a higher bid that Australian Super can accept. So it makes it really hard for any competition. Another big concern is there's a lot of other conditions with this offer. Having said that, though, I think there's a lot of concern about the performance of Healthscope going forward. I think,
even though they're moving to look at rationalising their property side as well.
That's right. I think some people feel that it's potentially could be a risky strategy, and that they're then exposing themselves to a landlord that would pay higher rents. Although, having said that, they are only selling down 49%. Which maybe the private equity lot wouldn't do. They might sell a lot more. Well, that's exactly it. But I mean, we do know that private hospitals are facing headwinds with more procedures, happening in day surgeries, so people not needing to go to hospitals to stay overnight.
And the threat of Labor's health insurance premiums.
That's right. So I think it's possibly why BGH thinks they can get away with buying this company without lifting the bid.
Right, well, we'll see how that goes. Now, another extraordinary development today was the listing of Coronation Coal, and we spoke to the chief executive a little while ago, but all is not well there in terms of the price on listing.
That's right. So basically, shortly after the debut of trade at around midday today, the shares, they priced at $4 in the IPO, but they were down as much as close to $3.50.
Wow.
So not a good start at all for Coronado.
Big float, isn't it?
It's very, very big. So the company, when it was priced last week, that took the value close to $4 billion. But it was a very unusual situation. There was a lot of messaging in the market that, there was really strong demand, that they were going to raise over $1 billion. Some locals were told their orders were scaled back because there was such a high level of demand. Then within the space of about a night or 12 hours, suddenly there was messaging that the deal was likely to price at the bottom of the price range. They were likely to scale back the amount of money they were raising. And then at the weekend, there was even suggestions that they may not go ahead with the IPO at all. So it was a bit of an unusual situation. We're not quite sure why, there was all this sort of change of heart. I think...
Who were the lead managers? I mean, it sounds like the dark art of syndication is sort of wandering all over the place.
There was about 3 or 4 banks on it. So, but the thing is that one of the challenges, I think, was all the demand came from offshore investors. None of the Australian institutions wanted to support it. And I think
it being coal, I suppose.
Coal, but also I think there was a bit of ill feeling about the fact that they were being asked to pay a lot more for the Curragh coal mine in Wesfarmers, which generated most of the company's earnings. And they paid $700 million for, and you know the way this deal's priced, it values the mine at more than $2 billion. Again, yes, coal is difficult sometimes to get investors or you know even resources to get them to support an IPO in the resources space. But
you see this as being rather badly managed, sounds like.
It's just very confusing about what's happened, and none of us are quite clear, you know, how they got it so wrong in terms of the pricing. So yeah, it is something to look at, I guess, going forward in terms of, you know, what actually happened.
Watch the price during the week. I'm sure there'll be some interesting analysis ahead as well. Yes. Thank you very much for joining us, Bridget Carter.
Thanks.
Now, the Prime Minister is trying to keep the focus on energy policy as moderates within the party demand more funding for emission reductions. The Morrison government will establish a price benchmark for power bills in a bid to push down prices, was one of the key recommendations, remember, from the ACCC report, and will establish a default market offer against which retailers will be required to set their prices. It's designed to tackle the gap between expensive standing offers paid by customers and the cheapest market offer out there available.
We want their electricity prices to go down. That's what we want to achieve, and we have a plan to achieve that. And that plan is to get the big energy companies under control.
Yeah, well, he's got other problems. Rather, moderate Liberal MPs are demanding the Prime Minister inject $1 billion for the Emissions Reduction Fund. The fund was established under Prime Minister Abbott, and it pays participants to reduce emission. That part of direct action. The Prime Minister has left the door open to the funding push.
I've never ruled that out. I've never ruled that out, and I've always said that that would be dealt with through the normal budgetary process. And there's a budget next year. There's an ERC process underway at the moment. The current funding takes us through the current period. So, you know, I've always been open to that. There's a suite of things we're doing. Whether there's ARENA, there's the CEFC, there's Snowy 2.0, there's the small and large scale RET, there's the emissions reductions fund.
Meanwhile, the coalition is also reportedly considering demanding a full recount in the Wentworth by-election as a delaying tactic to Karen Phelps' entry to Parliament. Independent candidate Karen Phelps' probable victory over the Liberal candidate Dave Sharma will see the coalition become a minority government, relying on crossbench support to pass legislation. Well, the Daily Telegraph reports the coalition may ask the Australian Electoral Commission for a full recount of Wentworth due to the tight margin, which, if conducted, could actually delay Dr Phelps swearing in. This would give the government one less crossbencher to deal with and see them hold on to their majority for just a little longer. Meanwhile, Wentworth's former member, Malcolm Turnbull, refuses to be drawn on whether he was to blame for the result.
I'll continue to have things to say about important matters of public interest, but I'm not engaged in politics any longer. I'm retired.
Oh, well, Mr Turnbull isn't commenting on Wentworth. The opposition sure are. They're taking aim at Mr Morrison's leadership in a fiery question time.
Given the government's disastrous performance in Wentworth, why has Malcolm Turnbull gone, but you're still here?
I'm very, very happy to stand up as leader of the Liberal Party and cop it on the chin, Mr Speaker, for the anger that was expressed by Liberal voters, in particular, about the events of 2 months ago.
Got a bit on his plate, the Prime Minister. He says also he won't be horse trading on border protection after Labor proposed changes to legislation which seeks to ban asylum seekers from coming back into Australia. Despite this, there appears to be a shift underway on whether Australia will accept New Zealand's offer to resettle 150 refugees a year. More from Sky News political reporter James O'Doherty.
This is a significant about-face from Labor after first opposing government legislation that was proposed in 2016 to ban asylum seekers from ever coming to Australia. The Labor Party is now prepared to support the bill if some conditions are met. The opposition wants the government to confirm that if legislation passes, they will send refugees from Nauru and Manus Island to New Zealand. And Labor wants the lifetime ban to only apply to those refugees, not anyone else.
The government has always claimed that it's the back door from New Zealand to Australia, which is the challenge. Labor's proposing a compromise in relation to this. We're asking the government to listen to the voice of clinicians and stakeholders. If the government's fair income about this, if Prime Minister Scott Morrison's words before the Wentworth by-election were fair income, he would pick up the phone to Prime Minister Jacinda Ardern, and David Coleman would pick up the phone to me, enter into negotiations, amend the lifetime ban legislation, and we could get this done.
They think this is something to trade over. You don't get to negotiate with people smugglers based on horse trading in the Australian Senate. This is why Labor stuffed it up so much last time they're in. They thought that's how you manage this. It's just not how it works.
But the Prime Minister has indicated he is open to some negotiation.
So what I'm going to do is continue on the program that I have been working with some crossbenchers on very carefully, not in a big noting way, just getting on with it, managing the issues case by case.
One crossbencher supports Labor's change in policy to get children off Nauru, but if they go to New Zealand, Andrew Wilkie wants them to all be resettled at once. That won't be happening. New Zealand maintains its offer stands, but only for 150 people per year.
The offer that we made, which is to receive 150 people as part of our refugee quota, still stands. Nothing has changed. The provision is there for that 150 people to be included in our annual quota, and they would be added. They would be filtered into the quota as our capacity allows for it.
Are we talking 6 months or a year?
It would happen during this year.
New Zealand says it's ready to accept Australia's refugees. All Australia needs to do now is accept an offer that has remained unchanged since 2013. James O'Doherty, Sky News, Canberra.
After the break, talking big blockchain investment with Jos Dijsselhof, the CEO of the Swiss Stock Exchange, next.
You're watching Ticky on Your Money. Now, back to Ticky.
Welcome back. Well, this is a very interesting story for anyone interested in the Australian Stock Exchange and how they're going with blockchain. Look, the Swiss Stock Exchange, or the SIX Group, SIX, is the latest international exchange to adopt blockchain technology for its transactions. Out here for the Sydney Sibos conference this week, the SIX Group has been out and about talking up its plans for a 100% blockchain exchange for digital assets, including Bitcoin. Meanwhile, here in Australia, our own exchange has just delayed its transition to blockchain by yet another 6 months. It's not set to debut until mid-2021, unlike the Swiss platform, which is hoping to be rolled out in the first half of next year. So what's all the fuss about? Well, for more, I sat down with the chief executive of the Swiss Stock Exchange, Jos Dijsselhof. Jos Dijsselhof, thank you so much for coming in. Now, you're actually over here just to look, are you, at the conference?
No, we are also, of course, an active participator.
Yes.
But we're also looking around what the other people are doing in the industry.
Yeah.
But we also have our own stand where we meet a lot of customers and colleagues in the industry. So we're active participator and looking around.
Tell us about SIX, because it is a very different animal to anything that we have here in Australia. It's the stock exchange, but it's much more than that, isn't it?
Yeah. Stock exchange is our flagship and people know us for the stock exchange. But it's actually only like 15% of our business, because next to the stock exchange we also run all the post-trade processes. So we make sure that if a transaction happens on the stock exchange, it's actually also followed through.
Yeah, so all clearing, all settlement across Switzerland.
Yes, yes,
right.
And for clearing also internationally. We also do that internationally.
Yeah,
so
and you have a data.
Yeah. Second business unit is our financial information unit, which is the data unit.
Yes.
Where we take the data from our processes and our internal data streams, but also buy in data from other sources and then package that into a comprehensive offering to the market.
Now, and
that's also an international business. Yeah.
This puts you in a rather unique position, I would have thought, in terms of innovation and in particular changing the entire financial
system across to, well, some sort of blockchain or ledger technology. Would that be right?
Yeah, you're absolutely right. Because we run a lot of the value chain in the capital markets, we have an opportunity to really have an impact and apply new technologies and new ways of working, drive innovation across a bigger part of the industry than many of our competitors who are either a pure exchange or a pure information provision or pure payments player. We are an integrated capital markets and financial markets service provider, and therefore also have the opportunity to impact more wider and more deeper, I think, than some of our competitors.
Yeah, well, we're having a little bit of trouble here with the ASX trying to get our blockchain up and running because we've had to delay it because people are a bit worried about transition. You are, what's your timing? You're way ahead of us, aren't you?
What we do is we have our existing business, so from IPO to trading to clearing, settlement, all the way down. But instead of trying to apply blockchain into an existing process, we've gone in a different way. We basically said we will create a new digital exchange next to what we already have. So we don't have to do an open heart surgery on our existing business, but we actually create a brand new business like a startup. And that's going to be a digital exchange where digital assets, digital money will come together. You can transact like you do on a current exchange, and then settlement, clearing and custody is done all in one go. So it's a really exciting application of new technology, but the real purpose is not the new technology. The real purpose is to change the business model and step away from the T+2 model that we currently have to a within seconds transaction where you have the change of ownership done within a second.
Yeah, so Jos, what you're saying is that this T+2, you know, normally takes 2 days to settle. This will then become on that exchange simultaneous.
Yeah. The moment you do the transaction, everything else will follow and the ownership will change from the buyer to the seller within the second.
Yeah, and unlike the stock exchange at the moment here, which has the problem of trying to change chess or replace chess with some sort of blockchain or ledger technology, you've got worries here about how this happens. Have we all got our information that we need? And you know, you're actually going to have it brand new sitting over to one side, and then presumably the business will migrate onto it over time.
Yeah. We think this new exchange will be a challenger to our existing exchange, and over time will take more of the business because it will be more efficient, quicker, easier to maintain, less credit risk, less default risk. So there are many advantages of the digital world and the digital exchange, and therefore assets, when it's proven and when it's working really well, assets will move over to the digital world. That's our vision, and we thought that building something in parallel and then porting the business is better than trying to re-engineer your existing exchange.
Is it? How does it go in terms of an investment and a return on investment doing it this way? Is it more expensive to do it this way?
I think it's cheaper because you don't have to take an old system out and apply it to an existing process. You can build it from scratch. That's one. Second is there are really good partners, so you can work with many different partners to build it. You don't have any legacy to take care of. You start from scratch. So therefore, I think creating it like this is easier and is also cheaper.
And because you basically you run so much of the rest of the system, I suppose it's a bit of a captive audience you've got there as well. Would that be right?
On one hand, it's a captive audience, but on the other hand, we also want to open it up. So we want to make a real ecosystem, to use a buzzword, around this exchange so that many participants can interact with this exchange and also be part of the service offering. So I think we more see it as an open system in terms of people being invited to join, but we will have some rules around joining because it will be a permission-based and it will be a secure environment which will be regulated by our FINMA regulator or European regulators. It will have oversight of the central bank. So these kind of things are clear and have to be maintained. But on the other hand, we want to make it open and really create an open ecosystem.
As a separate thing, do you have, you do have crypto, don't you, traded separately?
We don't have crypto traded on our exchange. No.
You don't yet, will you?
In Switzerland, there is a lot of crypto trading. In Zug, which is outside Zurich, that's called the crypto valley of the world.
They don't pay any tax as well.
No, not much. And I don't think cryptocurrencies are the first asset class we will be looking at. I think that needs to be in a safer, more controlled environment before it would be admitted to our exchange. Because we want to have a regulated, safe exchange where investor protection, product quality, finality of ownership is all guaranteed.
Well, you talk about the stability, the rock that is the Swiss Stock Exchange.
Yeah, and we want to maintain that.
Yes,
but still be innovative.
But still be innovative.
Yeah.
So, in terms of the funding that you've put into this, I mean, you've had a pretty good year, haven't you, on the IPO front? You've had quite a good year in terms of funds coming in.
Yes, we had a really good year on the IPO front, but also in our financial information business, some of the other businesses that we're running. So overall, we're financially very sound to make this investment.
Yes.
It's also very much on strategy, because the Swiss financial community and the international financial community wants a digital world which is regulated and well organized. And of course, having the Swiss quality brand and being regulated, I think is a huge advantage over any other Bitcoin or any other exchange that is currently out there, which is unregulated. You don't know where your money is going.
So what sort of securities will end up on this exchange?
We could have currently bankable assets that are digitalized on the exchange. We could have native tokens, so cryptocurrencies could at some point in time be admissible.
Right.
We can have many different asset classes. We could even have art or other things which can be digitalized and then be sold in fractions also on the exchange. So once we've created the model, I think we can admit many different asset classes.
Okay.
Yeah.
Now,
that's what I mean with an open system.
Right.
Yeah.
What about other threats? Now, I'm thinking about Brexit.
Yeah.
Does that impact the power of the stock exchange? I mean, if there's a hard Brexit, you're going to take business away from London, do you think?
Yeah, I think we will take business away from London, but I would prefer a more regulated Brexit because that, in the end of the day, that's better for the overall financial system. Better options for end investors. Investing in different exchanges in different venues is better than having a hard Brexit and a real cut between Europe and the UK. But if there are opportunities for us to get more business, of course we will look at that, and of course we will go for it.
Okay,
for sure.
And just out here at the Cybox conference, presumably you're getting a lot of questions about how your technology is going.
Yep.
Anything interesting you've seen here?
Yeah, well, I've seen a lot of interesting initiatives. A lot of the initiatives are targeted at a part of the value chain. And like you said at the beginning, very rightfully, we have the opportunity to cover the whole value chain. I think that's a real differentiator of what we do compared to the other things that we see.
What about your fintech sandbox? How's that going?
Yes, let me talk about a little bit wider about innovation, because we invest heavily in innovation. We have a venture capital fund. We have a specific team to drive innovation. This digital exchange is one of them. It is a poster child and gets a lot of attention, but we also do innovation already today. We've created a cybersecurity monitoring offering. Cybersecurity, cyber protection is extremely important for many of our customers. They're not always able to do that themselves. We've created an offering with artificial intelligence tools from IBM together to market that in the market. We're looking at compliance offering. We're looking at many other innovation offerings.
Between the world's global exchanges, isn't it? What's on offer for fintechs?
Yeah, but we compete with the exchanges, but we also compete with payment industry. We compete with all the areas we're in, and we need to be innovative on all these areas. And of course, first mover has the opportunity to take the space, and the others then have to fight to get into the space. So first mover is a very important thing.
So finally, when are we going to see the new blockchain system up and running, do we think?
It will be up and running by summer next year with a pilot phase.
European summer.
Yes, and in European time zone.
Yes.
So they don't pinpoint me on the day. And then we'll open it up step by step after the pilot for more business. But like I said, it's one of the innovation initiatives. We at SIX are really proud that we run a stable, reliable exchange on one hand, and on the other hand we drive innovation. And Switzerland is a great country to drive innovation from, because there's a really good ecosystem to do that.
Jos Dijsselhof, fascinating. Thank you very much. We'll follow you closely.
Thank you, Ticky. Thank you very much.
Now, after the break, a possible Brexit extension on the cards for the UK. We'll get the latest with London Capital Group's Jasper Lawler next.
This is Ticky on Your Money, covering the big business stories.
Yeah, welcome back. British Prime Minister Theresa May says London may request a short extension to the planned transition period after Brexit to ease its exit from the European Union. Speaking to Parliament after a bruising EU leaders summit last week, Mrs May said that while she hasn't committed to an extension, nor does she want one, there are some circumstances where she might consider it.
For example, a short extension to the implementation period would mean only one set of changes for businesses at the point we move to the future relationship. But in any such scenario, we would have to be out of this implementation period well before the end of this Parliament.
Well, there's been a bit of a reaction. Her attempts to unlock the Brexit negotiations by considering an extension to this transition period beyond 2020 has really angered pro- and anti-EU factions within her Conservative Party, leading to further concerns of a rebellion. Well, for more, Jasper Lawler, Head of Research at London Capital Group. He joins me live from London. Jasper, good to see you there. Now, gosh, I can't believe this could be kicked down the road even further. But is this an opportunity, I suppose, for Theresa May to get her deal through?
Well, good morning, Ticky. I think the general feeling in the country at the moment is that this is just a bridge too far. Obviously, the idea of the transition period, or as Theresa May calls it, the implementation period, is to actually implement some of these changes, is to allow not just a cliff edge, but this process to be more gradual. But the whole idea behind that is to reduce the uncertainty for business, know that they can keep the same rules throughout this period, but know at a certain period of time those rules are going to change and they can plan for it. But if you just keep kicking the can down the road, as you say, then actually it increases the uncertainty because you don't quite know what you're planning for, the date that you're planning for, because it's an ever-changing goal. And I think what the country wants more than ever is just for the Brexit vote has happened. It just wants to be, some believe in a second vote, but at least we just want the actual process to happen. And that's the real thing that I think could unravel Theresa May on this one.
Yeah, and it also, I was reading, potentially increases the risk of Europe and Remainers in Britain maybe pushing the whole thing back and cancelling Brexit altogether. Might that be a concern for people who want to get out?
I think that's been the concern from day one, is that the establishment in the UK were very much behind remaining in the EU, and that everything would be done to kind of trip and fumble along and just fudge the exit so that it in fact isn't an exit by nature. And if ideally possible for those who voted Remain to at some point create enough uncertainty and upset about the process that they're able to completely reverse it. That has been a concern from day one, and I think this the reason that Theresa May is unlikely to get either support from Labour, because it's just pure opportunism from the opposition party, or from the Conservatives, is because this is just not delivering on the vote and you know, basically upsetting those who voted and feel strongly about it within the Tory party.
So, Jasper, does this take anything any further? And a question, does it make her position more untenable at the moment? There are sort of these rumours now, once again, of her being toppled, but isn't it all a little bit late?
Well, I suppose there's always some candidates waiting in the wings, and so at the moment the main argument for her not being toppled is there isn't an obvious replacement. But I suspect that you know, over this last period of time, really since the Chequers deal, perhaps since Boris Johnson stepped aside, there's been probably machinations in the background for her removal, and so I think that's probably, so far about this transition period, I mean, I've basically been emphasising the negatives because it does create the uncertainty, it does make her position more untenable in my opinion, but I suppose the positive spin is that businesses potentially have more time to plan. Maybe it's a tiered process, as she said there, that actually maybe it's not all changed at one date, it's over a few different dates and you don't have such a hard date to plan for. Perhaps there are some positives here, but I think you've got to look at the net effect, and it probably just makes the government less in control and does overall create more uncertainty for the business environment.
Right, well, a big sigh on that one. Actually, that's not what moved markets today. What is everybody focused on in Europe at the moment?
Well, it's really all about Italy at the moment, Ticky. It could be as soon as today that the EU takes the fairly unprecedented step of just rejecting Italy's budget proposal. So the nature of the beast, being the part of a political union, is that all the individual countries propose their budgets to the EU to get the sign-off. So, basically you need to keep your spending within 2% of your gross domestic product, and Italy is looking to push well past that territory, and they have a lot of debt anyway, so the EU is very reticent to approval. It has approved budgets over that margin in the past, so obviously the calls from Italy are that this is unfair and that they need this budget and this is what their voters plan for, and obviously it just brings up the whole concept of the European Union again. How much autonomy should these individual countries have to decide their own fate? And that was the big concern with the election of this government in the first place in Italy, that they are going to push Italy away from the Union and potentially away from the monetary union, which is the big concern for markets.
Well, indeed, and that's why, of course, the whole example of Brexit is so annoying, I suppose, for Brussels. What's it doing to stability within Italy? Is that another issue? I mean, because it is this extraordinary coalition, isn't it?
Well, one of the amazing charts that I always like to throw out every so often is the fact that if you look at, this is pre-Brexit, but the proportion of the population who would like to leave the EU and or would be prepared to have a referendum on the EU, the percentages are much higher in Italy and France than they are in the UK, and the UK voted for it. So you can understand that the EU are very much concerned about the precedent set by Brexit and the way this, the direction that this Italian government is leading the country.
Yeah, all right. Well, Jasper, we'll watch through today and see what happens there with Italy. But thank you so much for bringing it up to speed.
Thank you, Ticky.
Right, well, back here, Australian wheat exports are likely to plunge almost 50%, can you believe it, this financial year, as drought ravaged winter grain crops in eastern states. Barley and canola exports are expected to fall dramatically, with total grain production down nearly a quarter from the year before. In fact, Rabobank says this will go down as one of the worst in eastern Australia's history, with no harvest in vast areas of the eastern states. Global wheat prices are also forecast to remain in the higher range reached this year into 2029. So what does this mean for farmers and consumers? Well, for more, I'm talking to the man who knows all about this. Is Rabobank's agriculture analyst, Wes Lefroy. Wes, it's great to talk to you.
Thanks for having me on the show.
Yeah, now this is a milestone, isn't it? I mean, we haven't had this sort of result since, what, the millennial drought?
So we've pegged it as our fourth lowest crop. Our forecast is for the fourth lowest crop in the last 20 years and the lowest in the last 10 years. So, wow. As you mentioned, a combination of that extreme dry weather alongside the frost right across the country
and difficult for us to see because, you know, it's raining here in Sydney and parts of New South Wales has been quite heavily, but we've had that whole period of time, haven't we?
Especially here in New South Wales and also Queensland, for a lot of those farmers, this is the second year in a row that they're facing really dry conditions, and it's an ongoing challenge for them. And both in Queensland and New South Wales, we have seen the biggest falls in production, with Queensland down 51% year on year, and New South Wales down 55% year on year.
Yeah, so I'm looking at your little map here. Obviously, the saving grace has been Western Australia. It's one of the advantages of having a great big country, I suppose. But even over the west, there were pockets of drought, weren't they, coming in?
So at one point during the season, the West had a really dry start, and at one point during the season, once the rain came and it continued, there were actually, many industry analysts were actually pegging Western Australia to be close to their record production year.
I remember that, yeah.
Yeah, but there were some back-to-back frosts during September, which were very significant, and also the fact that there was some dry conditions in the north, which slowed down crop potential. So from that respect, we've put Western Australia, we've forecasted production of 15 million tonnes, which is the only state up year on year at 3%. Okay,
now moving forward to next year, what are the expectations? Because I mean, farmers, as you say, that was year two. Is it going to get any better?
The critical watch factor is, of course, what comes from the sky, and particularly the rain. So we've seen some falls through October, and while this on the whole is insignificant for this year's crop, it's a little too late, especially for those in the north.
Is it also too early, though, for next year?
Well, it'll go some way towards filling soil moisture profiles, but for those farmers in northern New South Wales and southern Queensland who are looking towards a summer crop, any moisture they can get for those soil moisture profiles will will help that summer crop.
Okay. Is there a big difference between, mentioned, canola there, pulses versus, say, wheat? Because pulses, I think, really suffered, didn't they?
Well, we saw a decrease or a natural rebalance of the pulse price coming down from the highs that we saw in 2016 and 2017. And from that, farmers' planting decisions, or the crops that they decided to plant, they moved naturally back to cereals, back in line with that pricing. So from that helped decrease, or that contributed to the decrease in pulse production. We also saw a large fall in canola production. So traditionally, canola is planted earlier in the season for a lot of farmers. Yeah. So from that respect, with large deficiencies in soil moisture at the start of the planting season, farmers were forced to cut planted hectares of canola.
Now, this is all quite important for our own domestic market. I mean, wheat obviously is a huge export market. What has this done to our exports?
Well, as you said earlier, we've forecasted wheat exports to be cut at around 51% for the total production across cereals, oilseeds and pulses.
That's massive, isn't it?
Yeah, absolutely. And it basically comes down to, on one hand, we've got very high feed demand, particularly from livestock in New South Wales and Queensland. And we've actually said in our report that we expect around 3.7 million tonnes of grain to head from the West and South Australia into New South Wales and Queensland. So on one hand, we've got a higher level of demand of grain heading into those states, but of course, as we've discussed, the lower production in those regions as well, which is ultimately leading to lower export availability.
Yeah. Meanwhile, around the rest of the world, as I understand it, certainly some points this year, there was also drought everywhere. There was a drought in Europe. Russia had problems. So what's that done to prices? In other words, if we are exporting, at least the prices are good? So
with lower supply this year globally, we've seen prices move from a range where CBOT wheat was trading from 400 to 450 US cents a bushel over the previous 12 months. We've seen that move into a range at around 500 US cents a bushel of the slight tightening of the global stock. So this will be the first year in 6 years we've actually seen a deficiency in global stock. So demand will actually outstrip supply for the first time in 6 years.
Which is actually good for any exporters that can manage to get their crops out there.
Exactly. Yeah? So from our perspective, particularly in Southeast Asia, which are our major trade partners, countries like Russia, the Black Sea countries, and also Argentina will have a greater market share in those countries this year.
Yeah. So back to the east, I guess the big question is, do you plant or don't you?
Well, initially for the summer crop, yes. There's many farmers making that decision now and into the next couple of months on whether they have enough soil moisture to get the crop out of the ground. And of course, summer storms and any moisture that can be collected over the summer will contribute to the winter crops next year.
Well, it is a great report. I recommend everybody have a quick look at this because it's really interesting. Wes Lefroy, thank you very much.
Thank you very much for having me.
Well, after the break, a deal done for CBA's Indonesian life insurance business. More on that and more with InvestSmart's Evan Lucas next.
Now, back to Ticky.
Yes, welcome back. Well, in market news today, Chinese billionaire Richard Lee has splashed the cash for Commonwealth Bank's Indonesian life insurance business, snapping up an 80% stake of PT Commonwealth Life for $426 million. The deal will see PT enter into a 15-year distribution partnership with Lee's vehicle, FWD Group, with customers set to keep the benefits of their existing policy. The bank saying the sale part of a continued simplification strategy. The transaction set to be finalised in early 2019, pending regulatory approval. Well, for more on this and a few other things, Evan Lucas, Chief Market Strategist at InvestSmart, joins me live from Melbourne now. Evan, I suppose this is more of the same thing from the banks. It's another sell-off.
Yeah, it is, and I think you probably need to look at it more from the point of view around how they actually look at life insurance as a whole, and it's not just with CBA. So life insurance now is under a lot of pressure twofold. One, from regulatory issues that we've seen coming out of the Banking Royal Commission, and we know all around that, but also because the margins and the capital requirements inside life insurance just aren't as positive as they once upon a time for. Also, most customers are actually now starting to ask the real question around what their premiums get them, and that is also part of this whole movement. If you have a look at life insurance and the actual movement inside of it over the last, particularly the last 5 years, the drop-off rate is quite high, and therefore the non-renewal of subs is also part of the reason why CBA, ANZ, NAB, etc., take your pick, is moving away from life insurance businesses. It is not as lucrative as it once was. There is a high amount of capital requirements, and again, the overall sort of regulatory environment that is likely to come in 2019 and beyond is also part of it.
Well, I was going to say, it doesn't sound like it's a very lucrative business model anymore, but I mean, if it was a lucrative business model, they might not be allowed to do it anyway because of the wash-up of the Royal Commission when it comes.
Yeah, and that I think is the best way to sort of look at this as well, is have a look at, like, a good example is somebody like Suncorp, which is, I'm not highlighting them for any bad reason or one shape or the other, but they are clearly trying to diversify themselves away from the insurance sort of division that they are seen as to an overall banking and insurance provider. And they, therefore, if you have a look at their numbers over the last 4 years particularly, that their general banking division is what's realistically helping them drive forward rather than what was their major part, which is their insurance. And again, life insurance is a big part of this. They haven't seen the renewals like they once upon a time did. Again, their questioning has come from customers around, what do I actually genuinely get from my premiums? And all of that is brought down to a reason why life insurance is shrinking.
Okay. We've had, of course, over the last couple of weeks, those bank chief executives wandering through, getting the parliamentary grilling. They've, of course, got to return to the Royal Commission and go through presumably a rather more forensic grilling at the Commission. Is there any word on other developments within banking and how we're going to weather the next few months?
Yeah, I think that's probably the better question is, exactly what happens over the next 2 weeks when we get bank earnings season. But the big three questions that are coming out of it are regulatory costs, home loan funding, and then also their overall loan mix. And let's start with the last one. So banking, as we've just discussed, is clearly shrinking down to what everybody thinks banking is, which is a bank that borrows money from a term deposit holder, puts a margin on it, and then lends it out to a home loan or a personal loan provider. What is coming and what is becoming clearer and clearer as the housing market steps back, particularly residential, that loan growth and that loan mix is starting to be distorted because home loans are a good chunk of what they do. In fact, it's almost 80% if you look at somebody like Westpac. And they have an issue also where it's obviously quite a large loan, therefore the amount of return off it is quite big. Personal loans don't have that kind of numbers, they're a lot more risky. Business lending, although it's a higher rate, again, also isn't as lucrative as residential property because it's a very simple product. So that's one area that I think you have to look at. Then regulatory is clearly the other, and how much of an impact is coming on that is already been put out there. You are hearing from regulatory side, from bodies like APRA, you're hitting regulatory bodies also from the government side, suggesting very clearly that it is going to be part of what they need to do and that banks need to be honest and take this on the chin and actually appropriate what should be probably the right connection, which is that customers do need to come first and therefore they do need to look at how much saying that yes, we are sorry is going to cost them into the future.
Okay, I'm into that. Now, let's go from another area to another area of crisis, which is the energy market. The Prime Minister today coming out with the default price, which we knew, this reference price we knew was going to happen there. Interestingly, Labor looks like it might be heading back towards an NEG, a national energy guarantee. I mean, is this part of the politics, isn't it? It's Wentworth and this rise in this awareness that everybody wants to do something about climate change after all.
Yeah, and not only that, business is also calling for it as well. So if you listen to what happened in the last 48 hours, I mean, you had BHP come on the front foot and say very clearly, just do it. Get on with it and do it.
Yeah.
We are ready for it. We understand that it's the future, and therefore stop bickering and actually get on with it and do it. Now, energy is also an interesting one from several different sort of angles in terms of how you look at it. Again, what is a competitive price? How do you actually make a competitive market in this world? Because again, although you can look at putting a price on carbon or whatever sort of mechanism you want to use to regulate energy and therefore also look at climate change, it needs to have a market that can actually give that back. And if you look at the European mechanism around the NEG sort of scenario, it isn't as lucrative as it once was because, again, countries have backed away from it. Therefore, the private enterprise inside those countries that are using some form of carbon pricing or carbon market has also therefore dropped away. So there is another part of this, is that the underlying structure needs to be sort of put into it. But business is ready for this. It is the future. You don't have to just look at a BHP. I think the best way to look at it is that the energy providers in Europe, so I'm looking at places like Shell, BP, ConocoPhillips, they actually believe this is the future too. So they are the ones that actually produce this, and therefore they're the ones I would probably want to listen to.
Indeed. Well, we will do just that. Evan, Lucas, thanks very much for bringing us up to date.
Thanks, Ticky.
Well, that's all for the show tonight. Tomorrow night, I'm very excited. David Buick, the great David Buick, returns from BGC Partners in London. Till then, thanks for your company.